Hello and welcome to the weekly wrap video. Quite a few things to catch you up on then over the past 5 trading sessions. Once again, it's been a very much central bank themed week, particularly with the ECB rate decision on Thursday. So I'll just crack on straight with that then. Unexpectedly, the ECB delivered once more, unveiling an arsenal of measures to help combat the deterioration in inflation expectations in the Eurozone. So to start off with, they cut all 3 major rates. The negative deposit rate has been cut further, down to minus 0.2%, the main refi rate down to 0.05%, and the marginal lending rate down to 0.3%. As such, this did result in some aggressive weakening of the euro currency once more, but this euro weakness was extended further. At the press conference, ECB's Draghi unveiled a new asset-backed securities and covered bond purchase programme that is to take place with immediate effect, but markets still await any further clarity on this, which is to be divulged at the October 2nd meeting of the ECB. So still a couple of question marks lying over this, that primarily being just what and just how are the ECB going to purchase, as well as just a total size of the programme. We did see ECB sources suggesting such a quantity could be roughly 500 billion euros and it would take place over around 3 years. But the actual depth of this market is still pretty unknown, so we'll more than likely see some pretty in-depth reports and analysis pieces on this as we progress through in towards October's meeting. Separately to this then, we did see some further news flow out of Ukraine. A lot of hopes have been put on the meeting in Minsk today, which has resulted in a preliminary peace protocol being signed between the leaders of the pro-Russian rebels in both Luhansk and Donetsk, as well as the Ukrainian President Poroshenko. So that ceasefire is due to be effective as of 4 p.m. London time in Kiev and eastern Ukraine. This is despite conflict being reported as recently as this morning over in Mariupol in the southeastern regions of the country, still suggesting that conflict could potentially not be over just yet, despite the ceasefire being called. Then to round it off on Friday, we had the non-farm payrolls report. It was a disappointment. A lot of people were looking for the fact that this would have been the 7th consecutive month of gains above 200,000, but this was a disappointment today, coming in at 142,000 against expectations of 230. As such, we did see a move up to the upside in both T-notes and equities, as markets look towards a potential delay to the Fed's rate hike timetable. However, this didn't really sustain into the close, as US stocks are still on track for a weekly loss. Not the same case though in Europe. Peripheral bonds, particularly in Italy and Spain, have continued to rally alongside their Greek counterparts. We've got further negative yields in the Eurozone. We've had Ireland, Slovakia joining all their counterparts in the short end with negative yields, as Germany, France, Belgium all extend their negative yield moves that we've seen since the start of the week. Looking ahead to next week then, more focus will likely shift to the continued digestion of what we've seen out of the ECB last Thursday, but also an eye will be keenly paid to those Scottish independence polls as we head in towards the referendum to take place on September 18th. As some of the polls showing a decreasing lead for the no vote did cause a bit of wobble in the sterling markets this week alongside their gilt counterparts, as UK traders continue to wise up to the prospects of a potentially independent Scotland within the next couple of years. As always though, they'll bring you any key releases as soon as they hit the wires next week. But that's all from me for the time being. I hope you have a fantastic weekend.